Welcome. In this video, Zbcn may increase 150% very soon. What should you do if you are holders? We will analyze this. Don't forget to subscribe, like, and please watch till the end to understand. The concept of a downtrend in the market is one of the most common structures encountered in technical analysis, and interpreting these structures correctly can directly affect the success of investment decisions. A downtrend is formed when the price consistently makes lower highs and lower lows over a certain period of time. In other words, every time the price rises, it stops at a point below the previous peak, and every time it falls, it creates a new low below the previous low. This indicates that the market is generally under the control of sellers while buyers remain weak. The presence of such a trend signals a negative market sentiment, weak buying pressure, and strong selling pressure. However, no trend lasts forever. If the price breaks above this downtrend line, it is one of the strongest signals that the trend has ended and a new uptrend may be starting. Breaking above the downtrend means that the sellers who dominated during that trend have lost their strength and buyers are starting to take control. This not only represents a psychological shift, but also a tangible change in the supply-demand balance. Because during a downtrend, most investors act with the mentality that every rise is a selling opportunity, whereas once the trend is broken, the perception changes to every dip is a buying opportunity. This transformation is often accompanied by a noticeable increase in trading volume. If the price breaks the downtrend line while the volume is also increasing, this breakout is considered stronger and more reliable. The breaking of a downtrend is not only a technical event, but also the crossing of a psychological threshold. Especially in assets that have been in a downtrend for a long time, most investors act with a sense of hopelessness, and potential buyers hesitate to enter the market. However, once the price moves above the trend line, this changes. This event triggers the perception that perhaps the worst days are behind us. At this point, technical analysts start to take positions, algorithmic systems generate buy signals, and traders with short positions are forced to close them. When these three factors combine, the upward pressure on price becomes even stronger. Such a breakout usually does not occur in a single candle, but over a process. As the price approaches the trend line, an intense battle begins between buyers and sellers. Sellers place strong sell orders to defend this line, while buyers place larger buy orders to push through it. Therefore, volatility often increases near the trend line, wicks on candlesticks become longer, and volume fluctuations are observed. If buyers win this battle and the price clearly moves above the line, market psychology changes significantly. In technical analysis, when a downtrend is broken, the first target is usually the area where the trend began or the nearest strong resistance level formed during the trend. Therefore, after a trend breakout, the price often moves toward these resistance levels in a short time. However, in some cases, after the breakout, the price returns to test the broken trend line. This is called a pullback and is seen as a sign of a solid trend reversal. During a pullback, if the price touches the trend line and rises again, it confirms that buyers have fully taken control. The most important feature of downtrend breakouts is that they are often followed by strong and sudden upward moves. This is because investors who have taken short positions during the trend are forced to close them after the breakout. These closing transactions create buying pressure. At the same time, new investors who see the trend being broken enter the market. All these factors combined can cause the price to rise significantly in a short time. However, it's important to note that not every trendline breakout means a true trend reversal. Sometimes the price moves above the trend line but quickly falls back below it. This is called a false breakout and often occurs with low volume, indicating that buyers are not strong enough. Therefore, to confirm a solid breakout, it's important to look at trading volume, whether closing prices are above the line, and candlestick patterns. The timing of a downtrend breakout is also important. Sometimes the price makes this breakout after a long consolidation period. In such cases, the breakout is more effective because there's pent-up energy in the market which is released with the breakout. Investors can detect this energy from price action, volume, and market sentiment. In summary, while the presence of a downtrend shows that the market is weak, breaking this trend means a significant change in market dynamics. When the price moves above this line, selling pressure decreases, buying pressure increases, and this often leads the price toward new highs. Of course, one should be careful during this process, get additional confirmations that the breakout is real, and never abandon risk management. Because while trend breakouts can offer great opportunities, false breakouts can also put investors in a difficult position. But we can't make decisions based solely on trends, so let's also look at other metrics. Keep watching. The RSI, or Relative Strength Index, is one of the most popular indicators used in technical analysis to measure price momentum, and it is favored by both professional and amateur investors to identify possible market reversals, overbought or oversold zones, trend strength, and trend changes. The fact that the RSI measures the strength of price movements over a specific time period and produces a value between 0 and 100 makes it especially suitable for analysis alongside trend lines. Just as a trend line can be drawn on a price chart, trend lines can also be created on the RSI, and breaking these trends often serves as a leading signal for changes that may occur on the price chart. In the current case we are discussing, there appears to have been a downward trend line on the RSI, and this downward trend has been broken. This breakout indicates that even if it is not yet fully confirmed on the price chart, the momentum has started to shift from downward pressure to an upward direction. Breaking a downward trend line on the RSI is also an important turning point in terms of investor psychology. The RSI shows the extent of buying or selling pressure on the price. In a downtrend, each RSI peak stays lower than the previous one, signaling weakening momentum. When this structure is broken, it indicates that momentum is now reaching higher levels with each price rally, meaning buyers are gaining strength. Notably, an RSI breakout can occur before a price breakout. This provides investors with an early warning before price movement. In other words, the RSI can show that momentum is recovering even before the price breaks its trend line. In the current scenario, the RSI has broken its downward trend line and is now in the retest phase. In technical analysis, a retest means that a broken support or resistance level is tested again by the price, or, in this case, the RSI value. A retest on the RSI is a very critical step that confirms the new direction of momentum. During this process, the RSI returns to the trend line it has broken and touches it, and if it manages to bounce back up from there, the breakout is confirmed as valid. This means that buyers are maintaining their strength and that the price could enter a stronger uptrend in the near future. If this retest is successful, sharp upward movements on the price chart often follow soon after. A successful reaction during the RSI retest can create a domino effect on the price. This is because many traders who use technical analysis watch RSI breakouts and retests closely. When they see a positive signal at this stage, they open or add to positions, adding new buying pressure to the market. At the same time, short sellers may start closing their positions, anticipating that the price will rise after the RSI breakout. These position closings become an additional factor that pushes the price higher. An RSI trend breakout and retest not only give an idea of price direction, but also help measure the strength of an uptrend. If the RSI moves up quickly after the retest and starts breaking previous peak levels, it indicates that the rise is supported by strong momentum. This increases the likelihood that the price will enter a longer-term uptrend rather than just a short-term bounce. One important point not to overlook is the level at which the RSI breakout occurs. If the breakout happens below the 50 level, it indicates a transition of momentum from the weak zone to the strong zone. The 50 level on the RSI is generally considered neutral. Staying above it signals buyer dominance, while staying below it signals seller dominance. In the current case, after the breakout, a retest is taking place. And if during this retest the RSI does not fall back below 50, it confirms that buyers are still in control. This is a positive sign for the price. Because RSI breakouts sometimes occur before price movements, they're considered a leading signal. This means that an RSI breaking its own trend line before there is a clear trend line breakout on the price chart can serve as an early warning that the price may soon follow with a similar breakout. This is why some professional traders carefully watch to see whether price or RSI breaks first, especially around strong resistance zones. If RSI breaks first, these traders may open positions without waiting for the price breakout. What happens during the retest phase often determines the future of price movement. If the RSI touches the trend line and bounces strongly upward, it increases market confidence both technically and psychologically. Investors interpret this as momentum is pulled back but is still strong. This can set the stage for more stable and sustained price increases on the chart. If the retest fails and the RSI falls back below the trend line it broke, it may indicate a false breakout. False breakouts often cause investors to open positions prematurely and then exit with losses. This is why patience is important during the RSI retest stage, along with closely monitoring price and volume movements.
In conclusion, the RSI breaking its downtrend and currently undergoing a retest can be interpreted as a positive development in the market. If this retest is successful, it could be a precursor to a strong price rally on the chart. The recovery of momentum, the strengthening of buyers, and the improvement of market sentiment all increase the likelihood that the price could reach higher levels in the near term. In such a scenario, the RSI reaching higher peaks could lead the price to test new highs, potentially marking the beginning of a long-term trend reversal.
The horizontal flag pattern is considered one of the most reliable continuation patterns in technical analysis, indicating that the price has entered a short-term consolidation phase while the overall trend remains intact. This pattern typically appears after a strong upward movement and is characterized by the price becoming trapped within a horizontal or slightly sloped range, as if gathering strength. In the scenario we're discussing, after a notable upward move, the price has confined itself within a horizontal channel, moving in a way that suggests it's preparing for another push. The upper boundary of this channel is one of the most important resistance levels in the eyes of investors. Once the price breaks above this level, the likelihood of the previous strong upward move continuing increases significantly. The key here is that this pattern is defined as horizontal. Its horizontal nature shows that the price is not in a rush to break above a certain level, indicating short-term profit-taking in the market while sellers struggle to push the price lower. These patterns usually form in the middle of a trend. After a strong upward wave, the price rests for a while before a second upward wave begins. This is why flag patterns are known as continuation patterns. When the price breaks the upper line, most technical analysts calculate the target level as the length of the flagpole. The flagpole length is the distance covered during the upward movement before the flag pattern began. In our scenario, when compared to the current price, this length corresponds to an impressive potential increase of about 150%. In other words, once the upper line is broken, it's assumed that the following move will be similar in size to the rally before the pattern. This 150% target serves as strong motivation both technically and psychologically. The formation process of a horizontal flag pattern reflects market dynamics very well. In the first stage, a strong wave of buying occurs, triggered by fresh news, positive developments, strong buy orders, or general market optimism. The price eventually pauses as short-term investors begin taking profits. However, these sales do not push the price down significantly because there are still enough buyers in the market. This balance forces the price to move within a horizontal range. Buyers wait for an upward breakout, while sellers hope for a downward break, but most of the time, the trend direction prevails. The reliability of this pattern is also supported by volume analysis. During a flag pattern, trading volume generally declines, signaling that big players have shifted to a wait-and-see approach. However, when the price breaks the upper resistance, volume suddenly spikes. This increase confirms that the breakout is not false, new buyers are entering the market, and the upward trend could continue. If volume remains low at the breakout, caution is advised, as the move may not be sustainable. The potential 150% increase is calculated through a straightforward technical measurement. The flagpole length is added to the breakout point. For example, if the flagpole length is $0.02 and the price at the breakout is $0.04, the target price becomes $0.06, representing a 50% increase from the breakout price. In our case, the flagpole length relative to the current price shows a much larger gain potential of around 150%. This level is highly attractive to investors and could spark a surge in demand immediately after the breakout. From a psychological perspective, breaking the upper line of the pattern represents the overcoming of a psychological barrier. Once crossed, investors who were hesitant to buy before may jump in. Additionally, many traders using technical analysis see this level as a buy signal, triggering automated buy orders. This creates a chain reaction that can quickly push the price higher. Another important factor is the time frame in which the flag pattern forms. Flags forming on shorter time frames can play out faster, but are generally less reliable. Those forming on longer time frames, such as daily or weekly charts, tend to lead to stronger and more sustained moves when they break. In our scenario, if the horizontal flag formed after a strong upward move on a medium to long-term chart, the likelihood of the 150% target being reached becomes even higher. That said, the possibility of the pattern failing should not be ignored. If the price approaches the upper line, but volume does not rise and strong selling pressure emerges, the price could retreat toward the lower boundary of the flag. In this case, the pattern may fail and the price could move sideways or even downward for a longer period. This is why confirming breakouts with volume is critical. The horizontal flag pattern offers a powerful opportunity for investors who believe the trend will continue. The nature of this pattern makes it easy to measure targets and manage risk more clearly. For example, when the price breaks the upper line, setting a stop loss just below the lower line of the flag can effectively limit losses in case of a false breakout. In conclusion, the current horizontal flag pattern in the market could be a strong signal of consolidation. Breaking the upper line could bring an impressive upside potential of around 150%. However, for this potential to be realized, the breakout must be accompanied by rising volume, positive market sentiment, and an overall upward trend. If these conditions are met, reaching the target level predicted by the pattern becomes technically possible, representing a significant opportunity for investors.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.